Let's break down Kendall's acquisition of Vaulter, what he does well and not so well, and what would Warren Buffett do. I'm Peter. I spent many years on Wall Street, and I worked in investor relations at Activision Blizzard and EA. In this video, we're going to discuss why Kendall wants to buy Vaulter, how he buys Vaulter and deals with other bidders, and how Kendall negotiates, and compare that with how Warren Buffett negotiates and how negotiations typically go on in real life. Waystar wants to buy Vaulter, a fast-growing online brand, because they themselves don't have organic, self-generated success online. This is a common business problem. Companies with old business models get replaced all the time. This is why Facebook bought Instagram and WhatsApp and wanted to buy Snapchat and would be a buyer of TikTok if they could. The rationale for Waystar to buy Vaulter makes sense to me. So how is Waystar buying Vaulter? Well, even before Kendall gets to the boardroom, Waystar has probably been buying shares of Vaulter in the open market, just like anyone else buying shares of another company. They can buy up to 5% of Vaulter in secret, but there's an SEC rule that will require them, as an activist seeking control of the company, to disclose their intentions if they go above 5%. Waystar will have to file Form 13D, disclosing their interest in buying control of Vaulter. And this will raise the price, because everyone will know that Waystar wants to buy the company. And that will allow arbitrageurs, investors who specialize in acquisitions, to come in and buy all the shares of Vaulter, knowing that Waystar will want to pay even more. It's a guaranteed risk-free profit for them. That's why they're called arbitrageurs. So before disclosing this information, Kendall needs to reach an agreement with Vaulter management, that's Lawrence, the CEO, and his investors, the owners of Vaulter, so that when a deal is announced and a tender offer is published offering to buy all the shares, the insiders will sell, the management team will stay in place, and it'll be a friendly acquisition. That's what Kendall's trying to achieve. Kendall needs this to be a friendly acquisition because Vaulter doesn't have any hard assets. This is not a company with oil in the ground, patents, or factories. Those are assets you can buy, and if you have a disagreement with the existing management team, those assets will remain in place. It's easier to buy a company with hard assets like oil in the ground, factories, patents, than it is to buy a company like Vaulter, whose principal asset are the creative people working there. Those people go home every day. Like they say, those assets walk out the door and they're easily lost. In fact, if Kendall buys Vaulter but doesn't manage the acquisition well, he could be left with nothing, despite paying billions. So now let's talk about the price in the negotiations. When Kendall walks into the room and asks, do we have an agreement? The price is $110. That's $110 per share. I think it was $110. It's never said, but I think it's $110 because he raised the price later to $120, and he seems to be working in increments of $10. Now, a $10 increment is a little bit unusual. It's kind of large. In fact, if we assume this company has 20 million shares, a $10 increment is $200 million. That's a pretty big chunk of change for just a tick in the negotiations, but it's not unheard of. Sometimes prices are set for psychological reasons. Like, for example, Elon Musk, when he said he was going to take Tesla private, said $420. No coincidence that that's a pot slang term. He used the same term when he said he was going to acquire Twitter. He bid $54.20. The $420 remains, again, an important psychological number for Elon, and I suppose $10 is not an unreasonable tick mark for Kendall in these negotiations. Now, 110 is a convenient way to think about the price, but it's not the price. It's just the price per share. If we assume that Vaulter had 20 million shares, then 110 is $2.2 billion. But that's still not enough necessarily to buy the company. Now, when you buy a company, you get the cash they have on hand, but you also take responsibility for their obligations. If they have debt, if they have guaranteed contracts, leases, or salaries, you'd have to pay those too. In the case of Vaulter, we can assume they have something like $50 million, let's say, in cash and no debt. So therefore, at $110 per share, it would cost $2.15 billion to buy the company outright. And that's the current bid, or the first bid. That $2.15 billion is the true cost to buy the company, and that's the bid at that point in the negotiation. Now, if you have $110 per share as the acquisition price, that includes an acquisition premium, which is typically something like 30%. If that were the case, that would suggest that Vaulter shares were trading at around $85 per share prior to announcing the deal. That means that at $110 per share, selling shareholders will get an immediate 30% return. They'll get $110 per share. Those shares were only worth $85 the day before. They should be thrilled to sell. But that premium is also why acquisitions are typically value destroying and why buying shareholders often get the worst of the deal. Selling shareholders love acquisitions. Again, they get that immediate profit. And selling management also likes acquisitions. If I'm working for Vaulter Management and I have a 3-year contract and I'm going to get options every year, if a deal is announced, I'll get all those options accelerated. I'll collect all the options immediately without having to work for those 3 years. And I'll get them to be exercised at the acquisition price. That's, again, including that big premium above the current market price. So acquisitions are typically great for selling shareholders and great for the management team that gets acquired, although oftentimes they lose their jobs. But not in this case, because this is a company that needs its management team in place to continue the rapid success and growth that they've been showing. So far, the deal seems reasonable. But will Kendall overpay? Yes, it looks like he will, because Lawrence, in that first round of negotiation, says, I can get a lot more value for my shareholders, for the Vaulter shareholders. That's money that's going to come directly out of the pockets of the Waystar shareholders. And then Lawrence leaves.
We appreciate your interest in our little outfit, but I think that's it.
Come on. That's it?
He walks out of the room. That's good negotiating. And then immediately Frank asks Kendall, do you still want the deal? And Kendall says, of course I do. Kendall needs the deal. Kendall says, it's the secret sauce. It's part of the big plan. Kendall wants to become CEO of Waystar, announce a transformational deal, and, be a hero. And these are strategic reasons to overpay, but I don't think they're good reasons. And this is definitely not how Warren Buffett buys companies. Warren Buffett has published his acquisition criteria on his website and worked hard to develop a reputation as an acquirer who leaves management teams in place, sets a price, and does not negotiate. And it's worked really well for him. Warren Buffett, I think, and most investors would actually believe that there are no intrinsically good or bad deals. They're simply companies that can be acquired at a good price or a bad price. And if it's a bad price, it's a bad acquisition. But that's not how Kendall is thinking. Kendall wants the deal. He needs the announcement. So he raises the price to 120.
I'm pushing the bid to 120, okay?
Okay.
If there's those 20 million shares outstanding, he's added at least $200 million to the price. Now, it may be even more than that. As the price increases, additional options are in the money and exercisable. So maybe instead of just 10 million shares, maybe there's now 11 million shares, and he's actually raised the price instead of $200 million, maybe $220 million. Who knows? Not all that is very clear. Things happen so quickly in succession, I kind of doubt that he's worked things out this well. But typically in a real deal, there'd be a lot more due diligence and people would have a very good sense of the true cost of changing the price. It's not just 110, 120, etc. Kendall's father, Logan, checks in and asks how the deal is going, and Kendall explains that he's taking the deal from 110 to 120. Logan doesn't share Kendall's enthusiasm, doesn't need a major announcement. If he didn't like the deal or if he thought it was kind of so-so at 110, he likes it even less at 120. And then later, Kendall calls to tell Logan, we're on the 1-yard line, which I think is a terrible metaphor for closing a deal. In football, when you score a touchdown, that's a win. But overpaying for a company by raising the price over and over again is not like scoring a touchdown, despite what Kendall says. Dealing with other bidders. Here's where I think the script for Succession really gets a bit off base and kind of into fantasy land, in my opinion. A banker calls Kendall and says, PPG Bank has their nose in. There's another bidder. What do you want to do? And Kendall, the financial genius, says, we will cut PPG Bank in on our fees if they make the other bidder go away. If PPG Bank were willing to do this, this would be a conflict of interest and a breach, and I'm sure they would be sued. But somehow, in the script of Succession, this works. I don't think it would work not only because it's a breach, but because if there's an interested buyer, the bank can't make them go away. A buyer would just come along and get another bank. There's dozens of banks that can present a bid. So I don't buy this at all. This seems completely far-fetched, but it works in the script. And later, Kendall goes on to gloat to Lawrence, I don't know what happened to the other bidder.
Sorry, the other offer fell through. I don't know what happened.
Again, this makes no sense. He shouldn't know anything about the other bidder unless he's tampered with it, and he seems to be sort of implicating himself in that. And if there are no other bidders, why would Kendall be paying such a high price? None of that made sense. Finally, at the end, Kendall recaps the whole deal. He says,
The number is 140, cash with a stock alternative.
what that means is that the final agreement is $140 per share, which if you again assume the 20 million shares, maybe a few million more because of additional shares in the money, the price to buy the company went from $2.15 billion to over $3 billion. So it's been a huge increase in price. Now, the selling shareholders can get $140 per share, which is like a 65% premium over the pre-deal, pre-announcement price of $85. It's a great deal. But if they take cash, they're going to have to pay capital gains taxes. And, that's a big tax. A lot of people would prefer to avoid it or at least defer it. And you can defer those taxes by exchanging those shares for shares of Waystar Royco. Now, those original investors in Vaulter, if they ever want cash, will have to pay the capital gains taxes. But again, it's nice to be able to delay the taxes or manage them a bit. Personally, I would not take the Waystar Royco shares because Kendall might be in charge. He's not the most convincing, confidence-inspiring CEO. And, the taxes will have to be paid at some point if you ever want to see cash for those shares. So I'd say take the cash. Don't remain an investor personally, given all the risks involved. So the last comment on the price that I think is also sort of a tell, Kendall says to Lawrence, you have to sell or I'll see you in court. Now, I don't understand really how he could see Lawrence in court except as a shareholder of Vaulter. And it's true, this looks like an amazing deal for the Vaulter shareholders, too good to pass up. But the inverse of that and the implication is it's a terrible deal for the Waystar Royco shareholders and for Kendall's side of the deal. Now, in real life, with a board, with lawyers and bankers, there'd be a lot more people involved in the negotiations and a lot more due diligence. I don't think it would simply be Kendall sort of pulling numbers out of thin air and presenting them to a single person. For the purposes of the pilot of Succession, it's a little bit more fun that way. Now, Kendall isn't the most experienced executive. He's only there because he's the son of the CEO, and he doesn't seem to have a good awareness of either the risks or of his own psychology in managing the deal. A lot of investors make similar mistakes. They don't handle risk very well. They lack awareness of all the implications of what's going on, which is why I recommend people read The Psychology of Money by Morgan Housel. I think it's a great book on how investors can avoid making those kinds of mistakes, and I have a video on it which I hope you'll check out. Thanks, and goodbye.